Good afternoon, everyone. We are just past the top of the hour, so let's go ahead and get started. My name is Doug Skinner. I lead Business Intelligence Services here at AFS. Thank you for joining our webinar today titled The State of Commercial Lending Mid-Year Review, presented by AFS. If you aren't familiar with us, let me take just a few minutes and tell you a little bit about our company. AFS has been in business for over 50 years. Our commercial lending platform, AFS Vision, serves as the premier platform in the market today for banks and other financial service companies that are providing commercial lending services. We maintain a singular commitment to improving the commercial lending delivery model of leading U.S. banks. And you may also be interested to know that via our hosted private cloud, AFS is one of the largest commercial loan processors in the United States today. We also operate one of the largest and longest running commercial loan pricing and risk benchmarking consortiums in the US. In fact, all the data that you're going to see today is drawn from those sources. So if you'd like more information on any of that, please visit our website at afsvision.com. So just a few housekeeping items before we jump into the webinar. The session is being recorded, and we'll send that to all the registrants following the webinar. There's going to be 3 live interactive polls. We'd encourage you to participate in those when they come up, and we should get some real-time insight into how the audience is viewing some of the top-of-mind issues today. And then finally, if you have any questions, please free to ask them using the Q&A or the chat icons at the top of the screen. We'll try to answer all the questions, but if we don't get to yours, we'll respond via email after the session. It's now my pleasure to introduce Jeremy Charlson. Jeremy is a senior business analyst in our business intelligence department. He works primarily with regional banks, supporting their pricing analytics and reporting needs. He is an expert in the industry when it comes to credit risk and loan pricing practices in commercial banking. And many of you I know already know Jeremy and have been on his calls before, so I'm sure you're going to enjoy his comments and observations over the next 30 to 40 minutes or so. Over to you, Jeremy.
Awesome. Well, thank you for that intro, Doug. And echoing what Doug said, we know that banks are very busy during this time. It's certainly been an interesting few months as we kind of navigate some of the new volatilities in the market, both in broader financial markets and also across the commercial loan landscape. And what we thought today to make the presentation just a bit more focused and just to be respectful of your time, we didn't want to boil the ocean, so to speak. We want to focus specifically on one segment of the market that we think are showing some really interesting signs in terms of both loan growth and pricing, specifically the C&I market. So all the views you see here will be focused on commercial and industrial loans. We're not going to look at today the commercial real estate market. You can tune into future webinars for looks into that space. And we're just going to be focused on the bilateral space. Bilateral here meaning a one bank, one borrower lending relationship. So the syndicated deals will not be included in here, though participating banks do have access to some of that data. And what I'd like to do as far as an agenda today, I think we're going to look at the market across maybe 3 broad analytical layers. We're going to start by giving you some updates on what's been happening with loan growth since the election and since some of the new trade policy developments. We're going to then look at how those same forces are impacting spreads and fees. I think it's probably not a surprise to hear that we're still seeing a lot of competitive forces and competitive pricing in the market. And we'll drill into that a little bit more and see just how that's playing out across different sectors and areas of the market. And finally, we'll look at just some pockets of stress, because while it's too soon to really see how the tariffs and some of these other market forces are impacting credit quality, there are a few pockets of risk that we want to point out that could become larger problems as the year unfolds. So what I'd like to do is just take a quick poll of the audience, just set the stage for some of the growth and loan growth views that we're going to examine in just a moment. But just curious, among the audience today, if you could please answer this question: are you planning to expand or hold steady or reduce your commercial loan portfolio over the years? Just three simple answers to that questions. Are you planning to expand, actually pull back a little bit on growth, or hold steady? Renee, if you could please launch that poll, and we'll gauge how the audience is feeling on that front.
I see the results just coming in here, Jeremy. Just give it another minute, let people respond. So, Jeremy, the kind of the overwhelming consensus is expand. 82%, 4 out of 5 are feeling pretty positive about expanding their commercial loan portfolio. A minimal number reduce, and 14% hold steady.
Very interesting. And I think that the reason for that is we're coming out of a period where growth has not been very robust, and more banks are trying to find ways to grow top line revenue through loan growth. But what I'll say is that wherever you lie on that strategic spectrum, growing loans this year is going to be challenging for the reasons illustrated on these graphs. These are some survey measures of how businesses kind of how they feel about the economy and their future prospects in terms of sales and the political climate. And if you look on the left-hand chart there, this is an optimism index that where they survey small businesses on how they feel about near-term economic conditions. And you can see that just following the election, we saw a surge in optimism. One might say cautious optimism, but optimism nonetheless, where businesses were feeling good about the potential for deregulation and tax cuts that would provide a much needed boost to the economy. Unfortunately, that optimism was short-lived as tariffs and volatility in trade and government policy quickly left businesses scrambling to plan their next moves. Instead of optimism, I think the dominant word these past 6 months, or for the first half of 2025, really would be uncertainty. We really don't know what's going to happen in terms of tariffs. There have been some ways that businesses have been delaying the impacts of those, but all of these on again, off again tariff announcements really have been clouding hiring and investment decisions among businesses of all sizes. That's what the index on the second graph measures, in which uncertainty actually peaked to the highest level ever recorded by the NFIB. And this index actually goes back all the way to 1970. The good news is that businesses and even banks too are developing what you might call a certain degree of numbness to all of this economic news, that we've been living with this uncertainty for such a long time. And we're also coming out of a pandemic period as well, supply chain disruptions, and I think more and more businesses are just learning to live with uncertainty. We are seeing some green shoots that are trying to emerge in the CNI loan market, and that'll be our focus over the next few slides as we dissect loan growth. Now, while you might not think of uncertainty as actually being a good thing in terms of loan growth, it's actually provided a boost to CNI lending. For the industry as a whole, 2024, the previous year, was very challenging. Demand was weak as borrowers were really trying to wait out the results of the election. And on the supply side, banks had pulled back lending as they rebuilt deposits. What seems to have jolted the market out of that sluggish period was actually the announcement of tariffs. And specifically this spring, two things happened. One is that manufacturers stocked up on foreign goods before the fees took effect. And the second was companies actually pulled forward their inventory build. So the net result of the tariffs and the trade policy volatility was a very powerful, albeit transitory, impact on business loan demand. This came in the form both in terms of higher line of credit utilization as well as net new borrowing. But I think the million-dollar question is, how long will this upturn last? We have heard on the earnings calls that some banks feel that their pipelines are encouraging. That was the word that I heard used more than once. But the broad consensus is the US economy is poised to slow in the months ahead. More sectors are experiencing job losses than gains, and higher prices from tariffs haven't immediately showed up yet on inflation reports. I think the coming 6 months will be very telling on that front. Even assuming we get some trade deals, and I know a couple have been announced just this week, I think one with Japan and one with the European Union as well. The current effective tariff rate is estimated to be anywhere between 10 and 20%. And at that level, that's already going to shave off perhaps a percentage point of GDP this year and possibly add 1.7 percentage points to inflation. That's not a backdrop that would suggest that we can maintain this momentum going forward. I don't want to be too pessimistic, but I think some of these broader forces that begun taking shape in the spring are really going to start to take a bite both out of the economy, economic growth, as well as C&I loan growth as we work our way forward. Now, one of the most interesting sources of loan growth outside of the tariffs has been demand from what you might call non-bank financial institutions, which is kind of a broad category of anything from private credit to insurers to asset managers, where banks lend to these entities who in turn then disintermediate those funds to other asset classes and other stakeholders. It's been a sector that's been booming ever since the pandemic, and it's been one of the few strong and consistent sources of loan growth. Banks of all sizes have really been getting into this space. I think one of the reasons for that, and kind of what makes lending to these borrowers attractive, is they typically are subject to lower risk weights than other loan types. And this is due to the higher collateral requirements associated with these deals, as well as structures that allow banks to take senior exposure to a diverse pool of assets. This might sound on the surface a little bit like what we experienced pre-2008 with the mortgage boom, but I think there are some important differences to note. Specifically, the commercial loans to these non-bank financial institutions, they have had much higher recovery rates over time. And these companies do have genuine skin in the game. So I don't want to raise any alarm bells on that front. I think the larger issue is that really outside of this industry, we've seen only limited pockets of C&I loan growth in recent years. So it really speaks to the broader challenges that regional banks have had trying to grow top line revenue through commercial lending through traditional channels, be it through the manufacturing sector or some other conventional verticals besides the finance and insurance space. With that being said, kind of looking year to date in 2025, we have seen C&I loan growth surprise to the upside, particularly in the smaller end of the market. So here we're focused just on the bilateral lending, and we stratified that by commitment size range, with a trend for each range indexed relative to the start of the year. Now, most of the balance growth has come from the largest size credits, that time series on the far right of this chart. Those borrowers tapped lines of credit in March when the tariffs were announced, and they continued to borrow through the second quarter. And a lot of that growth was indeed those non-depositories, those financial firms that we had just looked at on the previous slide. But I think the more interesting trend to me here is second from the left, the trend in the less than $1 million loans. Growth here has been a relatively recent development, not necessarily tied to the broader economic and political forces that influence borrowing by the larger borrowers or larger businesses. When we drilled into this segment, this less than $1 million range, we observed very strong growth in healthcare, specifically loans to offices of doctors and dentists, as well as professional services firms. So anything ranging from lawyers to engineering firms to computer technicians. It was a pretty wide array of firms in that space. Loans to small businesses and small practices like that, particularly healthcare, they often are the basis for strong relationships that provide cross-sell opportunities, which render these deals attractive to banks that are trying to prioritize margin preservation. And we're hearing that's still a very large strategic focus of banks trying to protect spreads, trying to protect fees. And these loans can be a great vehicle to developing those relationships and earning other cross-sale and ancillary forms of revenue off those deals. Now, one of the key determinants of a given bank's loan growth is its industry mix. And here on this slide, we've grouped all the pricing dashboard banks based on their level of year-to-date balance growth for C&I. So the top performers in blue, and then the bottom third in that red series there. And a couple of interesting distinctions emerge that we pointed out here with the arrows. First, you'll notice if you look closer to the right-hand side of this chart, the fastest growing banks in blue are much more heavily concentrated in NAIC 62 healthcare. And again, this encompasses a lot of that acceleration in small business activity to doctors and dentists. So those banks that have really focused on that vertical have realized the highest growth among their peers thus far this year. Second, if the bottom group in pink, they're more focused in industries like public administration on the far right, and then on the far left of the graph, NAICS 22 utilities. These are what you might call safe industries, recession-proof industries, if you will. Unfortunately, they don't offer as many loan growth opportunities as, say, healthcare. So these banks might be trying to minimize risk, but they're doing so at a cost of growth. I think this all comes back to a saying that one banker recently told me, you can't be everything to all people. You have to pick and choose your verticals. So if you're looking to grow this year, which was per the poll that we just took, a strategic priority of many of our banks attending this webinar, being able to select the right verticals or potentially focus on the highest growing industries, that's going to be critical to outperforming your peers in what's proven to be thus far a very volatile market in 2025. Perhaps the question we get most in terms of loan growth is what's happening with line of credit utilization. And really, prior to recent economic developments, CNI line utilization was stubbornly flat. It fell to a very low level post-pandemic, and not much happened to really kind of bring it back to life up until that is 2025 with the announcement of tariffs. If you kind of look here, starting with the spring events, we started to see line utilization creep up, and even a percentage point increase in this metric is quite significant. Again, this was related to um, how businesses responded to the announcement of tariffs. Again, they were trying to manage working capital by stocking up on foreign goods, by pulling forward inventory build, and they did so by tapping lines of credits. And some other businesses too were drawing down on lines, what you might call defensively. They were a bit concerned about what might happen in the months ahead, so they were just trying to build a liquidity cushion to try to manage through all of this volatility. I will say there's also a slightly less optimistic interpretation of these results in which the higher utilization might actually reflect a normalization in credit quality. We have been seeing a slight deterioration in metrics like criticized loans and the percentage of loans that are past due, particularly in certain industries like leisure that are very heavily impacted by trends in consumer spending. So some of this utilization might also be from borrowers that are beginning to be a little bit stressed by just this continued high inflation, continued high rates, and then, of course, potentially higher input prices caused by tariffs. So a lot going on here. I still think this uptrend is encouraging and certainly something that we'll keep a close eye on in the months to follow. So as we turn our attention to pricing, I would like to get just another pulse from the audience on how they feel what their perception is of the current CNI pricing environment. Do you feel that it's highly competitive? Do you feel it's about normal relative to kind of historical standards? Or do you think that banks are being very cautious right now on competing on price? So Renee, if you could please launch that poll, and we'll get the audience's perspective on this question.
Okay, Jeremy, give them a few more seconds here.
Sure.
People read through the options. So it does look like, Jeremy, we have a clear winner. 62% right now have said their perception, which of course is usually reality, right, is that the current CNI pricing environment is highly competitive, fighting for every deal, about 62%. And then in second place, about normal, with rational rates and spreads relative to risk. And then about 1 in 10 are cautious, not really willing to compete on price, which actually aligns with the first poll, where a lot of people are looking to grow, right? So right now, about 64% highly competitive, fighting for every deal.
Yeah, thank you for that, Doug. And that's, I'm not a betting man, but if I was a betting man and I wanted to guess what that response would have been, I would have guessed that most participants or most bankers would have said the market right now is highly competitive. That really aligns with the conversations we've had with the pricing dashboard banks, who have all told us that right now, growing volume has sometimes come at a cost of unfortunately spread or loan coupons. Not always. Some banks are able to kind of manage both relatively well, but no doubt the market right now is very competitive. And one lens into that competition is the index makeup of new and renewed lending, which is illustrated here by commitment size. And if you had joined us for our year-end update in December, one of the trends that we had highlighted was an increase in the percentage of deal volume with fixed rate pricing. That's been growing across all commitment size ranges, and that trend has continued into the new year, into 2025. Admittedly, I was struggling at first what to make of that trend because, rates right now are still somewhat restrictive. So I was trying to kind of figure out the appeal of fixed rate pricing. But I think what's happening right now is what you might call a normalization in pricing mix. So following the inflation surge that we had in 2022, and then a liquidity crisis in 2023, both banks and businesses really shunned fixed rate structures. And now some of those earlier forces, thankfully, are beginning to ease. Inflation, while it's still running a little bit higher than 2%, has come down significantly. And deposit growth has also been impressive in recent months. And so I think the increase that we're seeing in fixed volume, it's actually in line, the percentages, the fixed percentages you see here in yellow are actually in line with where they were kind of prior to those other developments that I had mentioned. Certainly the pace of Fed interest rate cuts, if we have any at all this year, that's an open question in terms of kind of where the Fed's going to be in terms of how they feel the inflation situation is handled, but certainly rate cuts could also impact the appeal and the growth in fixed rate lending. In the larger end of the market, still seeing SOFR predominate. That's the blue series on these pies, which is comprising anywhere from 2/3 to 90% of the volume in kind of the larger deal size ranges. Also interesting that we're seeing some growth in prime for the larger deals. We haven't historically seen too much prime. for loans above 5 million. That's a relatively recent development. And I think part of the reason for that is actually there's a kind of a marketing or a psychological reason, if you will, for offering prime loans in that space. Typically, the prime loans over 5 million have negative spreads. And even if the effective rate is no different than that of a SOFR-based deal, having a negative spread can have some appeal when trying to negotiate with customers. And so we've been seeing some growth in prime rate lending, not just in the small end, but also for loans above 5 million, even for loans upwards of 100 million in size, believe it or not. So it's been a really interesting phenomenon that's been developing over the last few months or so. Now, if we examine the spreads charged on floating rate loans, those tied to SOFR and Prime, we see some really interesting developments. And just to help you orient your attention here on this chart, we have the SOFR activity on top with originations on the left and the renewals on the right. And then we have the same pictures, the spread trends for new and renewed for prime deals on the bottom of these charts. If you look at the top left graph here, really seeing a fascinating trend in the spread for new SOFR loans, which have been trending downwards over the last year or so. And in fact, in the second quarter, we reached a new low watermark in which the weighted average SOFR spread was beneath 200 basis points. So as all of you said on the survey, the market appears to be very competitive, and certainly the data would provide evidence for that sentiment. What's also really interesting is if you compare the top two charts, the spreads on renewals tied to SOFR have consistently trended beneath those of new loans. That's not something we've seen historically. If you go all the way back to 2017, 2018, kind of before the pandemic, it used to be that banks are more aggressive with pricing the originations. And I think what's happening here is there's been a renewed focus on trying to retain existing business. Capital markets are still very accommodating. There's still a risk that some of these customers might choose to refinance in the bond markets or via other financial avenues. And so banks are trying very hard and working very hard to retain some of their key business. And that's why you're seeing the renewal spreads trend so low. Also seeing some pressure on prime spreads on the bottom, where they've been narrowing quite significantly despite some of the Fed rate cuts. And again, I would attribute that more to the influx of some of these new large prime loans that typically command negative spreads. So all of this is to say that yes, the data does lend evidence to the sentiment that the market is very competitive, and I think it will remain so as more and more banks look to grow for the second half of 2025. So what I'd like to do next is actually give you a quick demonstration of how some of our banks are using our pricing dashboard application to actually manage their commercial loan portfolio. And bear with me one moment. I apologize for this. Just trying to, there we go. Go to the our pricing dashboard application. And what I'd like to show you is actually how we can use this tool, how our clients are using this tool today to personalize some of these trends, to get some more insight into their footprint. So Doug, can you just give me a quick confirmation that we can see this pricing dashboard? Awesome. So the pricing dashboard, it's really centered on helping banks profile the market and optimize spreads on their new and renewed business. So here, for example, this is our pricing trends report, where envision, if you will, your bank being this light blue series, which is a demo bank, and the market being the darker blue series. And we can track how pricing is trending both for C&I, and even though it's not our focus today, the commercial real estate portfolio, and see how your bank compares to the peers over time. If I click this slicer panel up top, we can then personalize this for your geographies, your size ranges. So for example, we're hearing a lot about how I think the government came out recently saying that the fastest growing region in terms of GDP has been the Southeast. So in this geography slicer, I can select the South region, and let's also focus on, um, let's say, deals under 5 million in size, which we also saw on an earlier slide that we're growing. So we'll focus on a growth market for this bank and specifically on what you might call kind of their business banking SME space. And now we can personalize all of these pricing trends just to be loans domiciled in the South region, the Southeast region, and for loans under 5 million in size. And if you look here on this chart, for example, this is a trend in prime spreads. You can see how in this neck of the woods, our sample bank here, the lighter blue series, has in recent months not been pricing quite as well as the market for the prime rate activity. And we can get some more insight into that. If I click that prime bar for the bank, what this is going to do is update this table here at the bottom. It will then show me a list of all of the bank's prime rate transactions in the period. And we can then sort, for example, by spread level. And what you can see here is that for this particular bank, they have a couple of really large prime outliers that have negative spreads in the period. So you can see, for example, if it's one or two loans that are weighing down your bank's performance, if the underperformance is more pervasive across the portfolio. But we here at AFS, both with our AFS Vision loan accounting system, as well as this pricing dashboard, we're all about highlighting exceptions, be it workflow exceptions or pricing exceptions, and really helping you understand specifically in your portfolio what might be driving your relative under or over performance versus the market. And once we've been able to profile the market and kind of get a sense for how well your bank is doing, we then provide some intel and some analytics that allow you to actually take some action to optimize spreads and interest rates on new renewed loans. So on this report here, what we've done is for this bank, again, this demo bank, we've listed all of their new and renewed transactions in the second quarter. And you can see, for example, the pricing terms for those loans. We can see, again, where they were located geographically, their size, and so forth. And what's really special about this report is for every transaction, we actually calculate a market equivalent interest rate. So a market rate that is based off of a pool of similar loans for the peers. And then we can take the difference between what the bank charges and what peers charge for comparable credit and create what you might call an opportunity calculation. In other words, if you're pricing beneath the market at clearing level, and we take into account the size of the deal, how much interest income are you leaving on the table? We can sum that across all of the quote unquote underpriced loans in the portfolio to come up with what we can see here, an opportunity statistic. And this says, in this bank's case, should they be able to address the underpriced loans in their portfolio, they could realize on average an additional $4 million in interest income. And in today's market where you're fighting for every deal, that's a huge opportunity. And I want to emphasize that the intent of this report is not to beat up the RMs or do anything like that, but more just to kind of show you that even if you could close the gap by a little bit on each of these underpriced deals, what we've seen is if banks can close that margin by even 10%, that can be anywhere from a 5 to 20 basis point improvement on interest income every year. So we're really through this report, we can give you some aspirational pricing targets to help your RMs, help your portfolio managers understand where in the portfolio you have an opportunity to lift price. So this tool is all about helping you profile the market, but also within your own portfolio, take action and identify opportunities to improve price, improve spread income, and do so without deteriorating other metrics like growth and fees and other key metrics of profitability. So that's a quick demo of the tool that we have, and it's really been a very popular mechanism, an analytical platform among our clients, And they're using it very actively to stay ahead of their peers as they navigate all this volatility and all of this pricing competition in 2025. So then going back to our pricing analysis, did want to mention just a few other key components of profitability. Here we're looking at the fixed loans that we're seeing in the marketplace.
Jeremy, can you
And
reshare the PowerPoint, please?
oh, I'm sorry, I thought I was. Let me go back to Teams here. Apologies for that.
There you go. Thank you. Okay.
Yep, I'm just gonna make it full screen. Sorry about that. Sometimes it's hard to navigate between screens. And so here we're looking at the fixed portfolio, some coupons on fixed deals on the left, and then spreads for fixed deals on the right, in which we duration matched relative to treasuries. We are seeing some signs of pricing competition for the fixed portfolio as well. Specifically, if you focus on the right-hand chart, if you match the fixed coupons relative to treasury yields, you can see that year over year, we're seeing a bit of a decline. That's because the treasuries, the longer-term treasuries have been trending upwards, whereas the fixed coupons have been coming down. We have seen some banks, not all banks, but some banks be very aggressive with pricing on the longer end of the term length spectrum, where, and this is not unusual, where in a competitive pricing environment, some customers will try to lock in low fixed rates, and some banks are willing to accommodate that. Now, I know there are ways to hedge that risk via swaps and some other instruments, but it's just some more evidence, if you will, that the market is still very competitive when it comes to fixed base pricing. And I'm actually going to skip ahead here, just a couple of other views I'd like to show, and then we'll take some questions from the audience. Fees are often a component of profitability that don't get as much attention or focus as spreads, but they're really a key component of profitability. And what we're looking at here are fees charged on originations and those charged at the point of a renewal event. We can look at both the fee incidence, so how often you're assessing a fee, and then the upfront fee level as the dark blue series. And what we're seeing actually, an interesting trend here is that the two series, fee penetration and fee level, there is a slight positive correlation. So it does seem like months in which one goes up, so does the other. So maybe there's certain periods when banks are more focused on fee performance. But the trend that is a bit more troubling to me is the dark blue series, the fee incidence, which really has come down quite a bit over the last 3 years. And in fact, if you were to go back even further in time, pre-pandemic, we used to see a fee penetration rate of 30%. It's closer to 22% as of the most recent quarter. So there has been a decline in fee penetration. We have heard from some banks and some RMs that said, look, if we want to get a good spread, we have to be willing to sacrifice fees. Funnily enough, when we looked at some of the data, loans priced with fees actually carry higher, not lower margins than those priced without fees. So you can have your cake and eat it too when it comes to spreads and fees. It really comes down to how you communicate that to the banker or to the customer rather. But we have found that there have been RMs that are successful at earning both high spreads and high fees. It is not impossible, and it is a key component of profitability that should not be ignored, particularly in this environment. And finally, we did have one other poll, but in the interest of time, I just want to show a couple of other views, and then we'll take some questions from the audience. I do want to leave some time for that. I do want to point out that we are seeing some trends in credit quality that are a bit concerning. For example, we are seeing, if you look at the percentage of loans that are designated as non-current meaning a loan that's on non-accrual or 90 days past due, we are seeing that metric start to rise, particularly when you look at it year over year. That's true across every commitment size range. The biggest rise has been in the smaller end deals, probably not a surprise, right? Because the credit fundamentals there tend to be a little bit weaker. But if you look on the far right of this chart, we have seen some volatility in problem loans for even the biggest deals. I really think that this prolonged period of high inflation, um, high interest rates has really kind of taken a bite out of profit margins. And certainly tariffs too. I mean, we have had some tactics these last few months where we've been able to kind of delay the adverse impacts of tariffs, whether it's goods being kind of uh, vetted through bonded warehouses or or companies loading up on foreign goods before the fees went into effect. But I think those tactics can only work for so long. I think tariffs in the second half of the year are going to take a bite out of profit margins of businesses and consequently are going to have an adverse impact on debt service coverage. Again, too soon to see just exactly how it's going to play out in terms of credit quality. But if credit costs start to rise for banks in the form of higher provisions or higher loan losses, that is going to be a trend that certainly will not be a good thing and certainly can offset any spread improvements that banks hope to realize kind of through more focused pricing. And one of the ways that we can track kind of how this is happening in real time is AFS has developed a risk migration capability where we can track how individual borrowers are migrating. We can look at that by sector, by geography. I have an example of that on this chart here, where you can see, for example, that sectors on the far left, like transportation and accommodation and food, accommodation being one very sensitive to changes in consumer prices and consumer spending, saw quite a bit of an uptick in the percentage of volume that migrated from past to criticized. I don't want to steal the thunder of my esteemed colleague Tom Cronin, who will be doing a webinar this Thursday. But if you're interested in learning more about what's been happening in the risk space and some of the credit risk drivers and trends that we're seeing in 2025. Tom will be doing this Thursday, a webinar centered just on risk migration and kind of where the market's headed from a credit perspective. So if that's something you want to learn more about, I certainly encourage you to tune in this Thursday, and you'll learn a lot about what AFS is doing on that front to research some of the risk drivers that are bubbling up in the C&I loan market. So it's certainly been an interesting 6 months, but we really appreciate all of you taking time out of your busy schedules to join us for this webinar. I certainly hope it's been helpful to unpack some of the key drivers of not only what's going on in the economy, but what's going on in a very important lending segment for all of us, that being the C&I loan market. Doug and I are always here to help banks better understand these trends. We love to hear from all of you. So Renee, since we have a few more minutes, I think we'll pause here and just see if any questions came through from the audience.
Jeremy, just checking. I don't see any questions. Doug, I don't know if you have any on your side.
I do not at this point. If give it a second here.
And Renee, I did get one question I'm seeing actually is, can we drill into specific geographic regions for these trends? And the answer to that is definitely yes. With our pricing dashboard tool, you can drill into local markets to see how this is playing out across your footprint. We can personalize all these views for your sectors and geographies. So yes, we can dissect the macro trends to get a more precise insight into kind of how these broader forces are playing out across your footprint.
So Jeremy, I'm not seeing any other questions at this time. I think we probably can go ahead and wrap up for today. certainly want to thank thank you, Jeremy, for the great presentation, and thank everyone for their time today. So have a good day. Give us a call or send us an email if you have any questions. We'll follow up with this recording in deck, and wish you all a good afternoon.
Yeah, and Doug, I just want to say to the pricing dashboard participants, an extra thank you for your participation in the program. And again, as Doug said, for anyone interested in just getting some more insight into that program or what we're seeing in the market, please feel free to email us. Thank you so much.